Welcome back to the Avenue. I am so excited today that you came in to see me once again. And this channel, we talk about real life, real money, and building real wealth. And today we're going to talk about building real wealth. This is the episode you've probably been waiting for because I've talked about investing in the past. And today I'm going to give you some tips on new investors that's looking to get into the market as soon as possible, and you've made up your mind that, look, I'm going to invest this year. I'm going to invest as much money as I possibly can. I have a few tips for you. Just remember, this is not financial advice. This is for educational purposes only. Let's jump right into it.
She's a go-getter, alright. What a beautiful sight. Anything she sets her mind to, she stays on it day and night. She writes the checks, she signs the deeds. She plants the fruitful seeds and still finds the time to meet all her family needs.
Okay, let's jump right in. I've been talking to you about investing, how important it is to invest, and you've probably heard others out there talk about investing and how there may be a wealth shift from one generation to the next generation. However, we need to get a good grasp on investing, specifically in the stock market today. I'm not talking about real estate. I'm not talking about in a business. I'm talking about the stock market, the stuff that you want to hear. And the first thing that I want to tell you about investing in the stock market is that it does take time. However, it is probably the most reliable form of investing that you can invest in. What I want to warn you just at the very beginning is do not put any money in there that you may need for the next 3 to 5 years because it takes time. You won't get rich overnight. That's not what this is about. Get rich quick scheme. That's not what this is about. This is about actually studying the market, putting the money in the market, and letting the money work for you. However, it takes time. I'm a long-term investor. I don't put some money in and take it out and get the gains and all that type of thing. I'm long term. So when I put money in, I'm not looking to take it out until probably about 5, 7, 10 years. Those are my plans. And really when I put it in, I really don't have a plan of taking it out anytime soon. So like I said, the least amount of time may be 5 years that I may take it out, unless something changes with that stock and I want to say, you know what, I'm going to take my money out before something else happens, or if something is on the way, I may take my money out then. But think of investing in the stock market as a long-term thing. It's not something short that you just put your money in, get the gains, and take it out. We want to practice long-term investing. At least that's what I'm teaching you about today, is the long-term investing. Now, there are some other short-term investing that you can do. Day traders, swing trades, all of that. You can do that if you want. I'm not teaching that. I don't know anything about that. People gain money and they lose money. I would say if you're going to go into that, first get your feet wet in the stock market. Then if you want to learn more about that before you start putting your hard-earned money in and letting it ride, or taking it in and out like that because it took you a while or probably took you some effort to earn the money. You don't want to just light it on fire or go throw it out in the street. You don't want to gamble with it. So make sure you know what you're doing when it comes to the stock market. And that's what we're going to talk about more and more. It's just some basic things you need to know to think about that will keep you solid in the stock market. Because over the years, like over the last 10 years, the stock market in general has averaged about 11%. Over the last 20 years, the stock market as a whole has averaged about 8.87%. So as you can see, even though it has its dips, it has its ups, it has its downs, eventually it goes up. If you would look at the chart, it will continue to climb up and up and up. So that's what we want to focus on. That's what we want to concentrate on. But it does take time. The second point I want to bring up to you is when you purchase a stock, and this is talking about an individual stock, you're actually purchasing a piece of a company, right? So if you go out and buy, this is just an example, if you go out and buy Apple stock, you're purchasing a piece of the Apple company, right? And so you have the people that's working in the company working for you. Of course, Apple wants to make money because any business is in the business of making a profit. They're not in the business of losing money. Now, when some of these companies first start up, they may not be making a profit right at the very beginning, but they have plans at some point in the near future, a few years down the road, depending on how soon they are and how early they are in the business, to make money. That's what you're in business for, is to make money. If you have stockholders or investors, you definitely want to make money because you want them to get a return on what they have invested into your company. So if you would have bought Apple stock like $1,000 worth 20 years ago, you all, $1,000 worth of Apple stock 20 years ago, it would be worth about $130,000 today. And that's with all the stock splits and, it rising in price and splitting again, rising in price. Your stock would have grown from 1,000 without you even investing any more money in it, would have grown from $1,000 to $130,000. Just think if you would have put $10,000 in that stock. But this is the way it works. It grows over time. But you are investing in a company. And who do you have working for you when you invest in that company? You have, first of all, the CEO. You want to look at the CEO to make sure the CEO is solid and they know how to move that company in the right direction. You have, if I were to look at companies, whatever sector I'm looking in, I would like to look at the very top companies in that sector. Because if I get the top companies in that sector, the top one or two companies, I have a great chance of having those best people work for me. And wouldn't you like to have the best people work for you? That's like picking a football team or some type of sports team. You want to pick the very best players in whatever position that you're going to put them in to play for you. And you're the owner of that team. So you're picking the players that you want to play on your team, knowing their track record, knowing that they can do what you want them to do. Who's going to be the quarterback? Who's going to be the tight ends? Who's going to be linebackers? You pick each and every stock if that's the way you want to pick individual stock. But I would definitely look at the top performers in whatever sector I'm looking in, because those are people that I want working for me and for my money to work as hard as it possibly can. Now, let's talk about market timing, because time in the market beats actually timing the market. It matters more that you have your money in the market rather than trying to pick at the lowest price that the stock is. If I knew the lowest price the stock would be, I would just sit and wait for that low price and then load up on it then. I don't know the people at the New York Stock Exchange. They don't know. Nobody really knows how far down a stock will go as far as price before you put your money in. And because we don't know this, we can watch it and we can see what the news says about it. We can see what comes out of the White House and watch it go up, watch it go down. And I would tell you, as long as I've been looking at it, most stock will dip every month. Now, they may not go way down, but they're going to decrease in the price every month, and they're going to go up in the price every month. So, but if you put your money in there, and sometimes the strategy is no matter what the price is, I'm just going to invest every month investing, and that may be your strategy. That way, if it's down, if it's up, if it's down, your money's in there and it's working for you. And so that may be something that you want to look at. I know it sometimes, once I have a solid amount of stock bought, but I really believe in that company, I will wait and watch to see when the dips are. And when the dips are, I'll go in and buy some more. And sometimes it gets to a price that I don't want to pay for that. So I just won't pay for it. But you have your strategy in that. But the main point is to put money in there and have it start working for you as soon as possible. If it does dip and you want to get some more in there, that's fine. If you want to just buy every Monday or buy every first of the month, just put money in there. If that's your strategy, great, do that too. But make sure you start something. Now, let's say that you're not so good about picking football teams or sports teams. You can go out and you can actually purchase a sports team. If you see all the players on that team, they line up with what you want to do with that team, you feel like they have a winning chance. You've seen their track record in the past. You know who they have coming in. You know who they have going out. And you're just solid on this team. You can do that. And that is called diversification in the stock market, because you can go out and pick either mutual funds or ETFs that will have a set amount of stocks in it, and then they'll be diversified over several sectors. That way, if one sector goes bad one year or 1 month, probably not all sectors will go bad. So you have a less likely chance of, if one stock goes bad, and loses you quite a bit of money or even goes out of business. Let's be honest, there is a risk that the stock can actually go bankrupt and you lose all your money. There's always that risk. Sometimes it's a slight risk because you know the company you're investing in. But if you diversify, all of those companies in that ETF will not go bankrupt, right? So, and there are people watching over the ETFs. So yeah, you know who's in there, who's not in there, and what's watching over it for you. Now, there is a slight cost for this, watching over that, but just think, you go out and buy a team. You know the coach is already in place. You know the players are already in place, and that's the team that you want. You don't want to pick individual players for that. This is a lower cost way of getting in, and also it's a more efficient way because you're diversified. So you're a little bit safer than picking individual stock out there, just in case you don't know really which stock that you want or which stock that you want to pick. So just keep that in mind, but you can diversify, and ETFs are great for diversification. So check those out. Speaking of timing, now is a great time for you to hit that like button and that subscribe button so that you can stay up to date on all the information that I'm bringing you. I love talking about this information. You know that I do. And just investing in general. This is my first video that I'm doing on investing. I'm probably going to do more in the future, but I want you to have this information so at least you can start thinking about investing in your money in the market, investing in something, because investing, in my mind, is no longer optional. If we're going to get ahead in life, if we're going to get ahead in the wealth world, we need to go ahead and invest. And speaking of getting ahead in the wealth world, I do have my financial therapy cards still available for you that will help you answer some questions, help you get your mind straight exactly what you want to do. It's a great deck of cards, 70 cards that ask various questions so that you can be crystal clear on what you want as far as your finances are concerned. Pick up a deck today and spread the word and spread this video out. Also, let me know, give me a comment. What are you investing in? Are you in the stock market? Are you in ETFs? Do you invest in bonds? Do you have a business? Do you invest in real estate? I'd love to know all of that. So leave me a comment. Okay, now we have controlling your emotions. This is probably one of the most difficult things that you will do as far as the stock market is concerned, because the stock market goes up, we're all happy, we're joyful, we're big smiles on the face and everything. But when the stock market goes down, we don't want to talk a lot about that, especially if we have some stock that has dipped and has dipped tremendously. So you have to control your emotions. You cannot be moved. If you're going to be moved like that, either you don't want to necessarily invest in stock that's a little more volatile, or you want to stick to the ETFs, or you just don't want to look at it, because there's some great stock out there right now, and it's going up, it's going down, and I don't even fret anymore when I see it dip. Actually, I go out and I buy more, and when it goes up, I'm happy about it. But I know that over the past years, the stock market has continued to go up. So I believe that it will continue to go up in value, the stock market overall, and you're losing out if you don't pick something, get in there, and start investing in those companies. Now, you have to be wise about the companies that you invest in, but you can do your research and find out more about those companies. But yeah, if you're emotional, it's a good thing probably not to look at it, because it's very volatile these days. It goes up, it goes down, but it just doesn't move me anymore because I've been at it long enough now. I know it's going to go up and I know it's going to go down. And when it dips pretty low, if you're in the right stock, it's going to recover. So I'm not worried about that, but you have to pull your emotions out, because if something happens, all of a sudden you get nervous and it dips, and then you pull all your money out. Guess what? You've just lost because you pulled all your money out. If it dips for me, I'm not pulling my money out. So I haven't lost anything yet, right? It's just down right now. And then when it goes back up, if I want to pull my money out then I've gained, right? But you cannot be emotional in the stock market. So just be warned about that. It's probably one of the most difficult things, or one of the more difficult things that you will learn as far as being calm, being cool, being collected, and just know this is what happens. I know the first time I got on an airplane, my sister had flown quite a bit, and I didn't like to fly, and I really don't like to fly that much now. But when I got on the airplane, she said, look, we're going to hit air pockets. That's normal. So it's going to bump a little around. If we get in a storm, it may waver a little bit. It may bump some more around, but that's just normal. It's just like driving your car down the street. You hit a pothole. And I'm like, cool. So when we started hitting the air pockets, I was a little nervous at first, but I'm thinking, okay, we're just hitting air pockets. That's all it is. I just hoped and prayed because, sometimes you get on those planes and they drop, they drop altitude. I don't know what they hit that they drop so far. You're not crashing, you're just going down and it'll finally come back up. But some of them are big dips, okay? I don't like for that to happen. The air pockets are okay. I know what they are and I know it's normal, it's natural. So we just go through things. And the good thing, if it's a good captain, he will let you know, look, we're getting ready to go through a storm, or I'm going to go up some more in altitude so we can override some things to make the ride a lot smoother. So anyway, just know that the stock market does have dips and it does have highs and lows. Don't become emotional about that. It's okay. That's the way it rolls. One thing I want you to pay careful attention to are the costs, because sometimes there are taxes, sometimes there are fees that you have to pay to invest in some of these things. Mutual funds sometimes have a fee, most of the times have a fee. ETFs sometimes have a fee. So you need to make sure you're looking at these fees, because some of these fees, if they're too high, they can eat up your profit. So you want to be aware of the fees. Also, if you start cashing in and getting money out, there's going to be taxes on that money also. So make sure you're calculating all of that in there. If you're making dividends on it, you're going to be taxed on that. So nothing is free, but you're still making money if you do the right thing with it. So go in and check into all of that before you start investing in anything, because I want you to be aware of the charges that may be coming your way, and they will tell you up front what the charges are, or read about it in the perspective what the charges are, so that you will know, because at the end of the year, they will send you a sheet of paper and they will all be there. And you may think, oh, I didn't know I was paying all of this, but you would know for the next year what you're paying. So pay close attention to that part. In the stock market, there are all types of investing strategies. Sometimes you have stock that will pay you dividends. And if there's a dividend stock, they may pay dividends out every quarter. So as far as they may pay, 25 cents or so per stock that you have, or maybe more than that. But every quarter you will get paid a dividend, and on those dividends you can hold them in your account, or you can reinvest those dividends back into the stock and buy more of it. But just know that that's one strategy. If I want to go out and just buy all dividend stock, at some point in time, if I get enough, I could live off of the dividends. Now, mind you, it takes a lot of stock to live off of the dividends. You could do something like dollar cost averaging, which is every month, every week, however you choose. You just buy whatever stock that you're in. You just purchase it every month, regardless of what price it is. That's called dollar cost averaging. And normally you beat the market when you do that, or beat the people that are picking stock when you just dollar cost average if it's a great company. You can do that. You can buy, long-term buy and hold. That's what I do. I buy the stock and I just hold it. Like I said, 5 years is probably the minimum amount I'm going to hold the stock. 7 years, and then 10 years. And so and I say 10 years because I'm retired now. And so 10 years, I'm looking to take money out of some of this stock and, go do what I want to do with it. But if you're young and, in your 20s, 30s, 40s, you can buy stock and leave it in for 20 years, 25 years or longer and just get more benefit from it. Just like I said about the Apple stock, $1,000 20 years ago would have yielded you about $130,000 today. So if you want to leave it in that long, you can become even wealthier with leaving it in that long. But just know that these are different strategies that you can use to do that. You can buy all index funds if you want to. You don't have to buy individual stock. You can buy all mutual funds if you want to. Don't have to buy individual stock. Or you can put your own portfolio together with individual stock. But you choose how you want to invest, and you have to do research to do that. I would say whatever strategy you choose, make sure you have stick with it. Just have that strategy and stick with what you say that you're going to do. You have to have a plan before you start this investing because you will need to know why you're investing. What are you trying to accomplish? So when you get there, you know that you've done exactly what you said that you were going to do. Now we're up to number 8. We only have one more to go after this one. Number 8 is vitally important, and that is do your research. Whenever you start out on this journey, whatever it is, I don't care if it's index funds, ETFs, if it's individual stock, mutual funds, whatever it is, do your research. And there's great sites out there for research. I would say Yahoo Finance is probably my favorite one for going out looking at the profile of companies. It'll tell you how much debt they're in. It'll tell you how much profit that they're making. It'll tell you the PE ratios, and you can research all of this, the head of the company, what new products that they're coming out with. It just tells you all of that information. What's the track record over the past years, over the past months, however you want to hear about it, that track record. So you'll know where this company, what they've done in the past, how they're headed towards the future, and you can make some good decisions based on the research. Because if a company is not fulfilling what you want it to do, and the predictions are out there, they also have other businesses out there that evaluate whether it's a buy, whether it's a sell. And you can look at those and look at their reasons why they're saying a strong buy or to sell it or to hold. There are various places out there that you can find that information. You can look at their track record as far as the ticker symbol and what they've been doing, going up and down in the stock market. You can look at that also. The chart, you can look at the charts on them. So there's all types of research that you can do. Make sure you do your research for yourself. I don't care what hot stock tip that you get from anybody. You know, if you get it from a family member, a neighbor, somebody at work, somebody on YouTube, doesn't matter who you get it from. Do your research before you invest your hard-earned money into that stock. So do your research, vitally important, before you start investing in the stock market. Last but not least, number 9 is, and hopefully this will be very encouraging to you because you do not need a lot of money to start investing. There are apps and there are sites that you can buy slices of shares. You can buy fractional shares. You can invest as little as $5, $10 into some of these stocks or the ETFs and build as you go. The main point is to start investing. Start somewhere. Start investing. You need to start today if this is the way you want to go. I made some investments in this one particular area and forgot about it. And I thought I had lost it. Then I pulled it up because they kept sending me emails. I'm thinking, well, I really don't have that because I thought I lost some stuff. And so I pulled it up, and sure enough, the money was there and I could see it on the screen. I'm like, oh, okay. And it has been years, you all. I hadn't touched it because I thought I couldn't get it anymore. I didn't know where it went or anything. And then I got into it and I saw it. And actually, I'm going to start investing more money into the site because I thought I had lost it. I found it. And actually, it's connected to one of my bank accounts. And so just to test it, I moved some money from it to my bank account and it showed up in my bank account. It's like, I'm good. So I'm going to start going back in and investing on that site. For me, I'm going to have more than one site I invest in because there's some things that I want to start doing differently. I'm probably going to get into options. I'm not going to talk about that to you because I don't know options like that yet. I bought a class for Christmas for me to get into options. So I'm going to study that and do the work behind that and get into options trading. But in the meantime, I'm still going to do my buy and hold in one account, do my options in another account, and cryptocurrency that I have a little bit of that in even yet another account. So I'm keeping things separate, but I know where everything is. Nothing has been lost. So thank God it all came back. So I'm ready for all of it. I'm going to do some heavy investing next year, you guys. So just to let you know ahead of time, if you're on my newsletter, I'm going to be talking about that more and more in my newsletter. So if you're not in my newsletter, there's a link down below for the therapy cards, as well as getting on my free newsletter that I send something out every month. And if something comes up, I'm going to make you aware of it as soon as possible. So if you want to get on my newsletter, hit me up on the newsletter in the link below, sign up, totally free, and you will be getting more information from me on that. So with that, it's been great spending time with you today on this investing, my very first one. Hopefully you've gotten some tips on how to invest. Don't be afraid of investing. Get started as soon as possible. Find you an investment platform. The ones that I'm using, I use Charles Schwab and I'm using Fidelity. Those are the two that I'm using for my investing. So check those out. There are others. E-Trade is one that you could use. So there's others out there. Then there's mobile apps on your phone you can also use. So, but with that, I will see you in the next video.
Go Adrian. Humble, go get a bless. Let's go.